Good day to one and all. This is Dr. Sivaraman of iknowindices.com. So I was presenting the part one of Tracking the Forex Market Together webinar between 9 and 9:45 GMT. Now we are at 14 GMT. I'm going to present part two of the webinar. So in this, basically, I'm trying to explain to you how exactly we can track the Forex market using the live market code page. And also, whatever be the type of analysis we do, how exactly we can do a fine-tuning of such analysis using the market reading technique. Then finally, in spite of all the market reading and the derived forecast, in the event if the market makes a move against us, so what are the contingency plans we have? And we should not become surprised, and we should not become tensed, or we should not have any sort of ambiguity how to handle it. So in a very systematic way, we should be in a position to handle when the position makes loss or when the market moves against us. So when the position is making loss, everybody is happy and they probably laugh it and enjoy. It is making more and more profit. But in such a scenario, also out of greed, some people miss to exit. On the other hand, when the position is making loss because of the past experience, that once the stop is placed and the stop is hit and the market moves as per the expectations, so they don't have the position to book profit. So invariably, predominant of the traders out of the past bad experiences come to the conclusions, I don't know whether it is right or wrong, that they try to trade without stop. But the trading strategy is a must. Without trading strategy, it is next to impossible to survive in this particular market. Because the market is bringing in such a big volatile moves, and if you do not have a measure or a mechanism which can act faster than your thinking ability. So when you take a decision to exit out of a loss-making position, but we always hesitate to close the position with a loss, with a last-minute attempt or with a last-minute feel that probably the market could move in our favor. In such a scenario, we miss to exit out of the position. Suddenly, the market may bring in more loss, and then we become helter-skelter, and we do not know how to handle the situation. And that is the main reason that many of the traders become frustrated with the forex trading, because it is not the system by which you read how exactly the market is going to make a move. Either we have to do a buy and sell trade or a sell and buy trade. And that decision you come across in many places, that you can take a buy and afterwards you can exit with a profit. But at the time of exit, there is an element of greed which induces anybody to maximize the profit without taking any trading strategy. So there comes the greatest miss between the cup and the lip, and many of the traders, even though they have seen the maximum profit, they invariably missed it out, or probably end up with making a loss in a profit-making position, which was making profit earlier, and later on the market reversed and making a loss, and they hold the loss-making position. So this is what you come across normally in the market, and the traders are willing to learn how to exit in such a scenario. So out of fear, if you learn any concept for that matter, and it will be used only for the defense purpose. So out of bad experiences, suppose you wanted to learn driving a car, or you wanted to learn how to swim, and when you continue to have some bad experiences, then you will try to develop an aversion in that learning process. So right from the beginning, you will become defensive. And you may not be in a position to learn or perfect the art. Suppose somebody learns driving and all the time he keeps the leg on the brake, thinking that anytime anything can happen. So it is better to keep the leg on the brake and apply it quickly. If he decides like that, then you will not be able to keep the pedal or keep the leg on the accelerator and try to move the car. The very purpose of driving the car is mobility. Try to locomotive from one place to another place. But in that process, the driving of art is not learned in a proper way. And if it is learned with bad experiences, then invariably you come across the mind become cautious and defensive. But in that process also, there will be an element of greed which will be triggering a person to try to explore it. Then it will try to give, based on the past experience, certain derivations, so logical derivations. And they will try to apply such derivations, not in demo trading platform, but in live trading platform. This is a very unfortunate situation. So when they lost money, then they will not have a self-reflection. And so I have tried various methods and I have lost so much of money. Then why should I try all new methods in a live account? Instead, let me try it out in a demo account and test that it is a reliable method. Then later on come to that of the live trading, because they lose the patience. They lost the money, they lost the time, and they wanted to earn as quickly as possible. In that process, they continue to make mistakes. So this is what you come across in trading. It is not applicable to any one individual. Every person who is entering into the trading arena invariably feels this. So there is a difference between an experienced trader and a professional trader. An experienced trader will always derive the conclusion out of the past good and the bad experiences. So if somebody says that I have been in the market for about 12 years, in the market for about 15 years, and so I know what it is, how to apply and things like that. When he says, that means he is overconfident and he has not learned the technique of earning money. He can give very good comment about the markets. He can always use various type of charts and give fundamental explanations for the fundamental analysis, technical analysis, etc. And he might be a good teacher, but may not be a good trader. So if you want to become a good trader, then you have to realize that I'm making mistakes as quickly as possible, like a professional. I am making a mistake. I have to rectify this mistake rather than blaming the market, blaming anybody else. So you have to blame yourself. I am making mistakes. I am going wrong in this trade. So I should curtail it and I should not commit similar mistakes again and again. So if there is a self-reflection and immediately you find that we are in a position to become a professional trader. And that is the most important thing. It is not that you learn it from the most sophisticated technical analyst in the world and say that I'm a professional trader. It's not that way. And a professional trader is a one who is able to recognize that, okay, this is a mistake. I had done it out of emotion. So how exactly I have to prevent it? Then I have to control that emotions. So you will focus on that emotion, the causal factor for such mistakes, and try to rectify it. So I am just talking about this mainly because many of the traders were under the grip of emotion and they try to say that I'm in the market for 10 years, 15 years, any number of years for that matter, unless and otherwise we develop the mindset to control our emotions. We are not going to be perfect traders. So once you control the emotions, you don't become bullish or bearish. You only identify the market as that in this market we can do a buy and sell trade, or we can do a sell and buy trade. That sort of scenario you will be able to establish. Now on Monday, during my Asian session live market analysis webinar, I was explaining that The players are trying to hold the market for a prolonged period. And on Monday and Tuesday, they try to hold at a lower level and induce the traders to commit sell positions. Afterwards, they gain the levels on Wednesday, Thursday, and Friday if needed, and induce them to do the short covering. And that way, they are building sell positions, inducing the short sellers to go in for a short covering. Because not many traders are going to take the buy at the highest level. Because anybody using common sense and logic will not try to take a buy at the highest level. And invariably, those who have gone short will go in for the short covering because there is no go. And the players are doing it for the past 2 weeks that way. So in this week also, they are expected to make such moves in the market. And that is why, even though I recommend sell and buy trade, because in this month of April, Euro and GBP are expected to make the downward move, and they are also expected to make the range bounds swing and quick drops till end of May and early part of June. Afterwards, only it is going to recover because now the players are holding high and building sell positions. Once adequate sell positions are built up, and later on, you will find they will take a very short time, short notice to make a quick drop in the market. And you know that gaining the levels takes several days in any market for that matter. And they have to do the circular trades and gain the levels. And if they simply withdraw the support so that the market, and the market simply falls. And so the falling happens in a shorter duration, even though they gain about 300, 400 pips, taking about 3-4 months, they make the drop of 300, 400 pips in a matter of about 5-6 days or 2 weeks maximum. So that is what you always come across in the market. And in such a scenario, I was recommending a buy and sell trade today during the European session. Why? Because the players are trying to hold the market and making a downward stop and inducing the traders to take sell positions before making a rise. I was just referring this during the European session. And you know that during that of the European session, I explained to you that what are the expected market moves for today. Then swing and firm up during that of the European session and swing and firm up during that of the US session. And they are expected to make the slide only by Friday. So to such time, they are expected to alternatively make the moves, but more firming up could be seen. And when you see the market reading technique, comparing the current market levels, you find that Euro has already breached the initial high, 1.3822, and it is trading around 1.3827. And GBP has come close. It is also breached the high. Actual high was in the platform 1.6728, but in the live market quote page it was 1.6744, and it has gone above and holding above. So what do you infer out of that? So they have been slowly gaining the levels, and they pretended as if during start of the European US session, as if it is going to fall. And further, they made that drop in the case of Aussie. So Australian dollar, the initial low was 0.9389. I took a buy there and kept the hedge order 30 pips below, and that got hedged and came down, and it came up to that of 93.59 and not breaching it at that time. So I kept stop at entry, they closed it, and again I kept 30 pips below that, another hedge 93.30. I'll show you the slide. And then subsequently they are holding it. They are expected to gain the levels slowly after gaining the levels in the case of Euro and GBP. This is mainly to handle the Aussie crosses. So Aussie crosses with the negative net change in the case of Euro and GBP, and with a nominal positive net change in the case of Aussie during the early Japanese session, they just dropped Aussie crosses, and now making us weak and Euro and GBP stronger. Their numerators are becoming stronger in the Aussie crosses. So you find that Aussie crosses started gaining the levels. So this is how they handle the crosses to start with. So now we understand that they breached already the high in the case of euro, also the initial high in the case of GBP, and in the case of yen, they breached the initial low and they are still holding the initial low. In the case of CHF, they breached the initial low and formed the new low, 87.88, and they are holding around the same level. And in the case of Canadian dollar, they just breached the initial high and also the new high, 1.1000, and gone up to 1.1014 and came down. So they continue to make an upward stop and afterwards make a dip, upward stop and make a dip. And then when the traders find that, okay, it is being well supported and take a buy position, they quickly make a move to 1.08 and use them to liquidate the long position and again gain the levels. That's what they are trying to do it in the case of in the case of Canadian dollar, Australian dollar, they are alternatively making it as weaker and stronger against that of the moves which are making by that of the other numerator currencies like euro and GBP. When they are in positive net change, Australian dollar is in negative net change. It is mainly to handle the crosses. Why they are handling the crosses now? Because there is no prime data release now. So they focus on that of the crosses and then subsequently alternatively make further moves in the case of majors during the late session. So this is what you understand once we compare the market with that of the initial lows and the highs. So as such, you find that my GBP position is making profit. It has not come down to 67.00, and I'm just allowing it to run for this session. As this session also, they are expected to gain the levels, and the momentum is very, very slow. If I would have closed by late European session, I would have got about 3 pips. Instead, I am just allowing to make at least about 20-30 pips profit, and some days are like that, we cannot help it. And just to show it, because I'm going to come back for the part 2, that's why I thought that I can hold it and show you that it will continue to make the profit. As I explained, that they made the extended move on the downside and afterwards the intentional move for 2 sessions and the start of the 3rd session. I can hold it till tomorrow, Japanese session, when they make a quick upward move and book profit. Now with regard to RC, which is hedged at 93.63, and I kept stop at entry, and the hedge got closed, and then subsequently I kept another hedge order at 93.30, and market is holding it. Came down to 93.46. The next hedge order will be 30 pips below that of the market at that time. Then how to handle in such a situation? This is the most important thing. Many of the people, when the position is hedged, they feel that they are struck. See, first of all, you need to understand, we are using the hedging instead of stop. Okay, that is the first scenario. So if you use the hedging instead of stop, what happens? If the hedge is filled, then we hold 2 positions, higher level buy and a lower level sell. But if we use a stop here, then the original buy position is closed with 30 pips loss. Whereas I am having 2 positions. And if we want to earn from the market the last money, suppose I keep a stop and which is closed, and I wanted to earn at least 30 pips in order to compensate the loss for the day, then I need to enter into the market. And I have to take a fresh buy position. Whether I am mentally prepared after a loss to enter into the market. So it depends upon the mental strength and also the equity available. So normally the trader will become defensive to enter, even though there might be a good opportunity to take positions, and probably whatever the method by which they study the market, they might find a great opportunity of entering into the market to earn, but still they will hesitate because of the bad experience. So always when the bad experience is seen first, then the second decision will be always very defensive. That is human psychology. So when you become very defensive in taking the position, what happens? The market is not waiting for us. It starts making the move. Then you realize that I could have entered long at an earlier situation, and now it has already gone up. So let me not miss the bus. So let me go and buy it now without understanding what they are trying to do. Then after buying, you find that happens to be the highest level buying, and afterwards the market was not going up at all. See, during the European session, I took a buy in the case of GBP at 67.30. I was explaining to you that because it is a webinar, I had to show you that in live condition, I'm taking a position, but that happened to be the highest buy. Afterwards, the market came down to 67.22, 67.20, things 10 pips, it came down. But I could have waited and bought it, but I will not be in the webinar. So since they are doing the intentional move, I know very well any level I buy, I'll be able to show the profit. And since it is intentional, they are not going to make a quick downward stopping. So I kept the hedge order. But in the case of Australian dollar, and 93.89 was the initial low. They came up to above that of the initial low, and they did not sustain there for more than 30 minutes in order to take a buy. But still, I know that I can use the hedging to limit the risk and also try to show a trade pertaining to that. That's why I took the position there. And then exactly it got hedged. And now another hedging order is working at 93.30. And as they gain the levels in the market, I'll maintain 30 pips from the market and try to move the hedging order upward till I'm able to keep stop at entry. So here, when you use the hedging instead of stop, we have two positions and we have time to take a decision whether the hedging is the right trade or whether the original position is the right trade. So now how to go about. So in that, let me explain to you that we need to understand the type of moves the players are making it. Okay. So in the market, normally what they do is they have to make the up and down moves and they have to confuse the traders, pretend as if the market is moving in line with the expectations and suddenly reverse. So these are all the mechanisms by which they'll be able to do that. And when all are sitting on the fence and wanting to enter into the market at the right time, and you know that in fxtrade.net, in the chat, if you watch, many people say that, okay, when euro comes to 1.3940, I am the seller. Okay, fine. But I wanted to ask such people, who is going to take it up to 1.3940? And is he a fool to take it up to that? And allowing you to take a sell position. So first of all, you have to understand, we make such emotional statements, but if you think that we are a participant in the market, there are other traders in the market, and who is willing to buy it at the highest level? Unless and otherwise, he has taken the short positions and he has to come for a short covering at the highest level. Otherwise, the market is not going to gain. So you always tend to find that the market is making the moves on its own. But basically, the players need to make the circular trades. They have to keep the buy orders, they have to keep the sell orders, and they have to buy the ask. Then the market goes up. They have to buy or sell it to the other bid when the market comes down. This is how they do the circular trades. Then you find it becomes green, red, and things like that. You find that market is really making some volatile moves. And you know that in the platform, you come across the 50 decimals and you find invariably it changes the figures. But if you carefully watch, referring to the fourth decimal, hardly market is making about 1 or 2 pips move. You'll be able to understand in the trading platform. Here you come across only the 4 decimals. So you find that market is very sluggish. So we are able to recognize it. But in the live platform, you will find that the trades are happening. But if you carefully watch, it will be for about 1 or 2 pips. So can anybody do a scalping for 1 or 2 pips? Because the pip variation is there and the spread is there. And if he is really willing to do a trade for 1 or 2 pips, you might be making a profit of half a pip or less than that. So nobody will be doing it, but that is being done by the other players. So the players continue to do the circular trades. They buy their own orders, they sell to their own orders, and that way they try to do it. And 2/3 of the volume in the market is of theirs. That is why they are able to really control the market. And okay, when they continue to float the market, then you tend to see that we will be able to do a buy and sell or a sell and buy trade. And then you need to identify what sort of moves they are doing it. Instead of simply trying to find out, okay, the euro is well supported, so let me take a buy. Instead of that, you try to find out what they are doing it in relation to the other market timings. So in the market timings, I explained to you that there are 3 sessions depending upon the closing and the opening of the banks, where they do through that of the deal rooms, the currency conversion trades for the exporters and the importers and also the government needs, etc. And so based on that, the session timings are being defined, and you come across a naturally occurring gap time. And these gap times are nothing but the time wherein the banks do not place active orders for such currency conversions. So they are all referred as the gap times. So during such gap times, when the banks are not really placing the orders for that of the currency conversion, the players can keep a higher level buy order and make an upward stop or a lower level sell order and try to trigger the stops at the bottom. So that is why the gap time, they try to make the false move. Now we are in the US session. 13:30 GMT, the US session starts. Now 14 GMT, 30 minutes past the start of the US session, and the early session is up to that of the 15 GMT. So normally early in the late sessions, they handle the majors, and in the mid sessions, they handle the crosses. So this is what you come across in the market. Now coming to that of the type of moves. So what they do is during the early and the late sessions, they do the stop-ins, either on the upside or on the downside. So you would have noticed during start of the US session, they made a downward stop and they came, or downward false move in the case of euro, and also downward false move in the case of GBP. They came down to 67.27 in the case of GBP and came to 37.79, 37.99. They came to below that of 1.38 in the case of euro. Just a small swing, a false move, a dip, so that the traders would think that, okay, euro is not having a strength to go up. Let me take a sell in the falling market. Struck. That will be the last sell. Afterwards, they will see the market goes up. So if you become emotional, you think that, okay, everybody is selling, let me also sell. And you will be the last person to sell in the market. Afterwards, the market will be recovering. As I explained, that USDN, they are making the dip now. Now, the false move is the one which they come up to that of the low and gain, or up to that of the high and drop. That is false move. In that drop or a rise, they immediately in 30 minutes time frame breach the opposite level, the high or the low. So once they go up to that of the high and come below and breach the low, then it will be a downward move. See, now in the case of Aussie, they have done it like that. So they have come down. So they go up to that of the high and started coming down. So then it will be, if it is a quick move, it will be an extended move for 2 hours. If it is a quick move for 30 minutes, then it is referred as a stop. If it is up to that of the low or up to that of the high and reverse, it will be considered as a false move. They do it depending upon the requirement. See, they do the false move so that those who have gone for a short selling, they do not book profit. Suppose somebody sells here, if they drop another 10-20 pips, what happens? They will be immediately closing the position with a profit. No, such scalpers will close. So they should not give any chance for them to book profit. So they will sell, afterwards the market has to go up. Only then they can be trapped. So that is what the players try to do it as a false move. And stop and is done when the traders are really taking the sell positions at the higher level, and afterwards the players wanted to drop the market, so they quickly go up and hit the stops of the short sellers and then come down, so that they will have the least buying pressure at the lower level. So once the least buying happens, immediately the market falls in a very big way. And the players want it that way, because once the market falls in a big way, they'll be able to maximize the profit without extending any support, so that they'll be able to get about 100 to 200 pips profit in the higher level hold and sell conditions. So we may simply call it as a consolidation, but it's a man-made market, so they have got a purpose. So they slowly gain like this and induce the traders to become bullish. And once the short sellers come for the higher level short covering, they give it to them. Afterwards, they don't gain anything and then stop making the slide. So this is what they do it as an extended move for 2 hours on the downside or on the upside. In the case of AUD, they are doing an extended move on the downside now. After 2 hours, they are expected to slowly catch up when Euro and GBP gain further. And intentional move is the one which is a prolonged move. It happens for more than 2 sessions on the start of the third session. So for 2 sessions, they continuously gain the levels. In the case of GBP, I told you, they made a quick downward stop and came below that, above that of the initial low, and started holding there and started gaining slowly the levels. Whole of the European session, they gained the level. And now US session also, they are slowly gaining, breached the high and then continue to gain buy. And in such a slow move market, if you think that Euro does not have a strength to go up or GBP does not have a strength to go up, we'll be trapped. Because they are absorbing all the sells and they are not giving any profit booking opportunities to the sellers. What happened? They have to automatically, the short sellers have to come for a short covering. So always when the quick move is seen, you can understand that they are all false moves. But when they slowly make a move of this nature, understand that it is an intentional move. Don't go against the market at that time. If they make a quick move at the final leg, tomorrow Japanese session, they will make a quick upward spike and then start making the slide. At the time, take a sell, we'll be able to see that profit can be booked. Identifying the type of moves, thereby you will be able to really take appropriate trading decisions. Otherwise, you can do a buy and sell trade now, or tomorrow you can do sell and buy trade. So there is no question of bullish and bearishness involved in that. So we control our emotions and try to read the intentions of the players and try to see how exactly we can capitalize the situation. And if you become afraid of the falling market, if you become afraid of the rising market, then we are not able to perceive. We are not able to see the truth in the market. We are not able to see the true sense in the market. This is what normally you come across. When Euro is at 1.38, it looks that it is a higher level to take a sell. But once they show 1.39, a higher level, then you do the short covering. Then once it comes back to that of 1.38, then it looks like a buy level, because we are relatively comparing to that of 1.39, 1.38. But at the time of rising, we compare it to that of 1.37 and see that 1.38 is a higher level. So it is a relative comparison. And once you try to relate it to that of the earlier levels, that's what we do it in the chart. So we try to refer to that of the earlier peaks and find, okay, it can go up. Then after going to that of all the peaks, we think that, okay, new high is going to be formed later. So we need to find out in the current situation what the players are trying to do it. We can always refer to that of the past. And we also have that saying that the market does not repeat the history. No, history does not repeat by itself. And in a modified form, it gets repeated. But we fail to understand what sort of modifications are involved in that. So we try to always backtest or always try to compare it to that of the past. But statistically, backtesting is meaningful. But as far as the dynamic changing of the market condition is concerned, backtesting does not explain to us what is going to happen in the future. Because the conditions in the past, some people may say that I got a history or the data pertaining to that of the last 50 years or 30 years. Fine. But they did not have the electronic trading system and or the online trading platforms. And anywhere the people can open account and trade. And such situations are totally different from the earlier situations. And if we compare it to that of 2005, 2006, I have seen USD making about 500 to 600 pips move in a single day. And Japanese yen used to trade around 134, 126 and things like that. But you do not come across such scenario. Euro was trading around 0.78, 0.82 and things like that. When it was crossing the parity, people were really thinking that can Euro strengthen like that? So they're all the past. But if you try to compare to the past, we are not going to see such things going to happen again and again. No, we need to understand the reality. So theoretically, it is fine. We can compare, we can backtest, we can do all those things. But being a statistics professor, I'm telling you that it is irrelevant to compare it to that of the future. Because you come across the dynamic changes happening in the market, and those changes were not seen earlier. So the market conditions were different. And those who have been in the market for about 3-4 years might be knowing the volatility was about 150 pips in a given day. Now, hardly you come across the change. Net change is 3 pips, 5 pips, 15 pips, 20 pips, 30 pips, and one currency showing 70 pips. Have you come across this in last month or the previous months? So there is a variation with regard to the volume and the amount of traders' participation, because when the traders continue to lose, they go away from the market. The market has to attract new traders, and the new traders have to come in. And it is something like the insects are attracted to that of the fluorescent light. And afterwards, when they die, then also they spread the message that don't enter into the market. It is a gambling den. Then some people avoid, but out of necessity, certain other people enter into the market. So everybody, you find they've got their own reasons to enter into the market, out of crisis or out of trying to make money in a quick way, because they have to meet a lot of debts and things like that. So invariably, you find people might be having various reasons or the excuses. Ultimately, they wanted to make the money quickly. But when you find that the market was earlier giving quick money, but now it is making really slow moves and testing the patience of the traders. So probably a trader need to wait for 2-3 days to book about 30-40 pips or 60 pips profit. On certain days, they might be making quick moves. So we need to identify the type of moves, how they are doing the swings, and whether it is the right time to enter into the market. Today, there are no big data release. So are they going to make really a big move in the market? Or are we going to simply watch the market and go in for the trade when the data release is there? And this sort of decisions, the traders have to take it from time to time. And it is not that all the time you come across similar trading strategies or similar trading conditions prevail in the market. So in the event of a position is hedged, this is what I wanted to explain during the European session. I did not have much time. So there are two possibilities if the position is hedged. So you got a higher level buy and a lower level sell. You watch for 30 minutes. And in that 30 minutes, if the hedging is not making profit, understand during the stop and they just filled your hedge. And afterwards, which is not making profit, and you try to close it with a nominal loss. And in the event, if the hedging is making profit and loss of 2-3 pips, 5 pips and things like that, beyond that, they are not going down. So in the case of Aussie, when I was, my position was hedged, the hedging was making only about 4 pips profit. It came down to 93.59. Afterwards, they are not going below that. So I kept stop at entry and they simply closed it. And then I kept another hedge order. So if the hedging is making profit and loss alternatively, you can smartly book about 2-3 pips profit when the new low is not being breached for 30 minutes and keep another hedge order 30 pips below, or keep stop at entry. Once the stop is filled, you can keep 30 pips below the hedge order. So that way you can handle it without making any loss when the hedge is being handled. Then the third scenario is if the hedging is making profit for more than 30 minutes. That means the market is going against. So you're able to immediately relate your position to that of the market and understand. But if you want to simply close your original position with that of the hedge, you lose only 30 pips instead of a stop. You use the hedging, you find that, okay, no, I'm not interested in this trade. You can simply close both the positions simultaneously. You will incur only 30 pips loss. So you get the time to take a decision whether to exit out of such trade. Okay. If the market goes down against you, if the hedging is making profit, then there are conditions. One, the market can continue to drop forever. That is one possibility. The other possibility, that is next to impossible. The other possibility is the market might go down and again come back, because volatility is the order of the game. So it has to come up after 2-3 days. Doesn't matter. I can keep stop at entry in the hedging. Let them take even 100-200 pips below the market and let them do whatever they want. Finally, when they come up, my hedging will be closed at entry, in the stop at entry. Then I'll continue to trade with my buy position. That is second scenario. You will be able to take a decision. When the hedging is making profit, and you see that the hedging is making profit for more than 2 hours, then you understand that they are doing the intentional move opposite to your entry. It is simple. More than 2 hours means it is an intentional move. So that means they are going to drop the market for 2 sessions on the start of the third session. Simply close your buy position with 40 pips loss, but already your sell position will be making 10 pips profit. So you will only incur a loss of 30 pips. And afterwards, if they continue to drop for the intentional move on the downside for 2 sessions on the start of the third session, when they make a quick downward move before making a reverse, if you close it using a trailing stop, you earn about 70-80 pips or sometimes 100 pips. And you lose about 30 pips in closing the buy position and earn about 70 to 100 pips on booking the profit on the sell side. Then you make a net profit of 40 to 70 pips. So you will be given the time to take a decision, which position you can hold it. But for that, you need to have a thorough understanding of the market. That is, whether the market is making extended move, quick downward move, and stop cutting the new low, or whether it's continuously making the downward move, cutting the new low every 30 minutes, cutting the new low every 30 minutes, forming the new low, cutting the low every 30 minutes, forming the new low. Now, cutting the high every 30 minutes and forming the new high. This is what they are doing it. Now, this is an intentional move on the upside. But here it is an extended move on the downside. So you need to differentiate the moves. Only with the help of the live market code page, you will be able to do it, because you've got the time frame to refer to. Unfortunately, this time is being referred to that of the US session time. So you can simply keep the GMT time frame, and from that of homepage of fxtrade.com and try to refer it and what exactly they are trying to do it. And related to that of the time, that is more important, the early, mid, and the late sessions and the gap time, etc. Then you will be able to find exactly each move is meaningful. They are doing it with a purpose. They are not making some nonsense move. They are only making the moves in order to induce the fear in that of the traders. Then the other alternative is, if the hedging is making profit for more than 2 hours, and you find that, okay, they are going to drop, there is no need to close my buy position, because after the intentional move on the downside, they are expected to make an upward extended move. When you find that sort of scenario, then once they drop, and during that final drop on the third session, you can book profit on the sell side, keep another hedge order. And once they start reversing the market upward, then you try to trail the hedging order upward until you are able to keep stop at entry on the buy side and continue with it on the buy side and book profit. So that is either way trading. This either way trading, you can make it much more smarter if you have adequate equity So suppose you have got a buy position and the hedging is filled, the hedging is making profit, you book profit in the hedging. Already they had dropped about 150 pips. Then take another buy position and the average of both the buy positions, if we take, and if the market moves 75 pips, we will have a break even. And the averaging should be as wide as possible so that when you take two positions with 150 pips gap, the average will be 75 pips from that at the bottom. So when they gain about 75 to 80 pips from that at the bottom, we'll be able to book profit, net profit on the buy side. So understand that averaging should not be done with 20, 30 pips. It has to be done with about 100 to 150 pips when the market moves against you, provided you use the hedging and book profit in the hedging, so that your usable margin is not eroded totally, because you have earned a profit on booking profit on the sell side, and that profit will be added to that of the free margin. And once the market drops, still your usable margin will be showing that less 30 pips because you just opened the hedging. So if you try to do the hedging that way, you find that hedging is really a handy tool. And also, in the event, if you are taking a position and afterwards the market makes a different type of move, and you are not in a position to attend to an urgent work, you can simply leave it. And after about 2 days, you can come back and find how exactly the position is making. And if the hedging is making loss and the original position is making profit, and you find that, okay, market is in the uptrend, you can still close the hedging with 70 pips loss. But the original position will be making 40 pips profit. So ultimately, the loss is only 30 pips. And if they gain another 30 pips, you are at break even. If they continue to gain another 30 pips, you will have a net profit. So this is how you can use the hedging effectively on either side moves of the market, because market means volatile moves. They have to make this up and down moves. We need to identify in what way they are doing it. You should not become surprised when they make a drop against your expectations or when they make a rise against your expectations. Then once you become stunned, then you go in for a crisis management. So I don't have time to take any position. Anyhow, I have the old position. Still, GBP buy is there. And also I explained to you that Australian dollar, the buy position is there. The hedge is closed and I kept another hedge order. And then once they gain the levels above that of the buy, I'll trail the hedge order upward to 93.63 and then further up and keep stop at entry in the buy side and then book profit on the buy side. If needed, if they had dropped about 100 pips to 92.93, then I take another buy and try to close both the buys above their average. So in the market, either you do a buy and sell trade or a sell and buy trade, you'll be able to really make net profit, provided you use the appropriate trading strategy at the right time. So let me answer to the questions. I think time is up. Okay, there is only one question, Andreas. Do you have any technique for forecasting when the volume increases? See, normally, I don't have any method by which the volume variations can be recognized beforehand. The volume variation depends upon the commitment of the traders in big volume and also the institutions. And that can be recognized spot with the help of the live market code page. With the help of the live market code page, we can easily recognize when they make the spread between the high and the low more than 40 pips, that means the volume is improved. Then the second, when they make such quick moves, then understand that traders are committed in the wrong side. So that is why they make the downward stoppant or an upward stoppant. So the players have got a purpose. When they make a downward stoppant, they've got a purpose to hit the stops. Why? Because predominantly the traders have taken a long position and kept the stop below that of the initial low. So that is why they drop and hit the stops before making further rise. So this you need to identify. Every move has got a purpose. Simply, you should not say, okay, they have done the downward stop and The next is upward stopping. It is not mandatory. They can do it anyway they want, depending upon the traders coming in positions, because they somehow know exactly the traders' positions and act against it using the billions of dollars. So that is why they continue to earn. They don't lose money in the trading. And such billionaires continue to retain the status, and they don't come down with regard to their earnings, and they don't incur loss. How? Because they do such type of trades and they don't take any sort of speculation. I cannot explain in the open forum beyond that. Okay, Joy. When Euro and GBP will drop, and they are expected to drop from Thursday or Friday, sir. And they are now trying to build a sell position at the highest level, 1.39 in the case of Euro and 1.68 in the case of GBP before making a drop. And so that is why they just make open low and hold it low and create a feel that it cannot rise. And when the traders sell, they gain the levels and induce them to do the short covering in 2-3 days of the beginning of the week. And later on, make one quick rise, telling some story. And afterwards, the traders come for short covering automatically. Then afterwards, they drop. Then what about gold? Gold is also expected to swing around 1,280 to 1,370 range for some time. And you'll come across 1,400, 1,500 after the month of June. Okay, no more questions? I think I need to wind up the webinar. So ultimately, what is more important is the forecast, the market reading, identifying the type of moves they do it, and the trading strategy. So if you got any doubt pertaining to this, you can contact me. And this is my website address. These are all my contact details, email, and the Skype chat ID, and also Yahoo chat ID, and my mobile numbers are there. You can contact me freely, and there is no cost involved in that. I will not do any sort of marketing with you. Please understand. And I take this opportunity to thank you all, and also thank FX Trade for the opportunity given for me to present my views about the market. Thank you one and all. So Thursday, I'll not be able to present Asian sessional web live market analysis webinar. I'll come back next Monday and continue giving for the next week the expected market moves. Thank you one and all. Wish you all happy trading.